Happy Friday, everyone. Welcome to Mortgage Markets and More. I'm your host, Peter D'Angelo. I have an update for you on how the show is going to be going moving forward. So our episodes now will be released on a cadence of a couple different episodes. So every week you can expect this update on your Friday morning so that we can review what's going on with mortgage rates in the market. But our Did You Know segment and then that exploratory segment that we do every week will be separate episodes released later on in the week. And for those radio-free Montclair listeners out there, don't worry, I will be putting all of the episodes together for you for your Friday morning update when this show airs there. Now with the housekeeping out of the way, let's start talking about the mortgage rate market and what's been going on. As we customarily do, these are the mortgage rates as of the Thursday morning before this episode's release, according to Mortgage News Daily Survey. And they are as follows. 30-year fixed rate mortgage is averaging 6.86%. The 15-year fixed rate mortgage is averaging 6.27%. The 30-year jumbo fixed rate mortgage is averaging 7.03%. The 30-year FHA mortgage is averaging 6.35%. The 7/6 SOFR adjustable rate mortgage is averaging 6.42%, and the 5/1 SOFR adjustable rate mortgage is averaging about 5.95%. That last one's according to bankrate.com. Overall, a little bit of relief on the mortgage rate front. Moving on to the bond market, right now we're seeing the 10-year yield pretty close to what it was last week. 10-year yield is at 4.309, the 5 years at 3.943, and the 2 years at 3.805. So the 10-year ticked up only by a hair when we're comparing week over week after some movement up and down in the course of the week. But more notably, the declines were in the 5 and the 2-year yields, which is also why we saw some improvement there on that 5/1 SOFR adjustable rate mortgage. The divergence that we're seeing right now in the bond market is hinting at the sentiment that the Fed is still maybe nearing a pivot this year, but there's no clear guidance on that. So we're going to have to wait and see. Some more things that are affecting mortgage rates over the past week in particular. We have the March CPI report. That's the Consumer Price Index. That's an inflation indicator. Mortgage rates relying heavily on expectations of the Fed. The Fed is looking at inflation and the job market. We've got a couple data points on that today. So let's talk about the inflation. Well, that headline CPI, which is taking into account everything and the change in costs, came in at 0.2% up month over month and 2.4% year over year. That's down from 2.8% in February. Some good improvement on inflation. That's a good sign. The core, which takes out food and energy, which are the volatile elements, that came in at 2.8% year over year price appreciation. And that is the lowest since March of 2021. So think about that right now. We're seeing some serious improvement on inflation. As far as the outlook here for April, we're going to be getting that shortly, but it's projected to be 2.38% year over year headline and 2.76% core. So there is expectation of a little bit more improvement on both of those numbers. That would be great. If we see lower inflation, we've got more of a case that the Fed can make to cut interest rates and provide some more relief. Stay tuned for more on that, but a disinflationary trend is a good thing, like we've talked about on past episodes. Trends are what matter, not just the key data points. But we unfortunately need to suffer through the roller coaster ride because the market focuses on just data points and doesn't take into account as much trend, which is important for us right now. The market reaction was pretty muted, unfortunately, which is why interest rates really didn't move much. If we had an inflation report like this 5-6 months ago with seeing that type of improvement, we would expect to see interest rates drop quite a bit. But there's a monkey wrench in the works. Tariffs. All this conversation about tariffs is creating volatility and chaos in the market currently because there's no clear guidance on what this will do for pricing. Prices and what the consumers are going to wind up paying if producers are going to, if they're going to absorb the tariffs, which is highly unlikely, then prices won't change as much and we'll see inflation remain where it is. But if these tariffs take place and then prices go up for goods because of imports, then that's going to get passed on to the consumer, which is going to create a new inflationary environment, this time due to tariffs. Right now, the current status is that there is a 90-day pause on all the countries that were announced from President Trump's tariff plan, where they're opening negotiations on these tariffs. The only country that's not part of that stay is China, which is still enough to keep the market muted when we see a positive inflation report. Now let's talk about the labor market. That's a key component here. The labor market saw the March 2025 jobs report bring in 228,000 jobs added that month. The best forecast and the 12-month average, and much better than the 12-month average, I must say. 158,000 is the 12-month average. So that looks pretty strong. The unemployment, on the other side, came in at 4.2%. That's the highest level since October 2021, but still low historically, so nothing to raise an alarm bell on, but there was a little bit of a tick up there. It's interesting to see the data moving counterintuitively. You would think, oh, well, if more jobs were added, there'd be less unemployment, but that's not what we're seeing. The leading sectors here are healthcare, social assistance, retail. There was a strike rebound is what we call that. When we see a tick up in the labor, that looks quite a bit better. It's normally because there was a sector that had a strike or layoffs or whatever it may be. And when the people return to work, it gets captured by the jobs added data. So it could be a job that was already held 3 months ago, but then the employees went on strike, they leave the workforce. Well, when they re-enter after the strike ends, they're considered new jobs added. So it could skew the data a little bit, but that is one sector that's showing some more strength and resiliency. And then the last one is transportation and warehousing. Overall, there are some caution flags. So the job openings in some states is falling. So that means there's less jobs available. In addition to that, we're seeing layoffs, uptick in retail, and of course government with the Department of Government Efficiency, everything you hear in the news about that, that is having a tangible effect of actually reducing the workforce in the federal government, which is causing these layoffs. So the signs are there of softening happening in the labor market, but nothing that's ringing an alarm bell yet. So we'll see how that develops. Federal Reserve policy, we'll revisit this again because we talk about these data points in the context of what the Fed is going to think. What the Fed's going to think about these things is we want to see trends. We need to see meaningful progress on inflation and stability in the job market. Just because the stock market's going wild with these swings hanging on every thread of news and everything that you hear about, well, as that's happening, the Fed is staying center. They are keeping an eye on everything. The stock market going nuts is not a reason for them. But inflation, jobs, a financial serious injury to a large cornerstone of a sector. These are the things that they'll look for. That's just not what's happening right now. Other factors beyond the tariff and the trade policy, because that has a trickle-down effect for us here, there's been a lot of volatility in the bond market. And that's the last thing I wanted to mention on our update section. Normally, and we've talked about this in the past, bonds work based upon price and yield. And so if there's a lot of attention, there's a certain amount of supply for the bonds. And when people want to buy those bonds, there's competitors bidding for the bond. The competition raises the price of that bond and it lowers the yield because the value is fixed. So when it lowers the yield, you get compression there on the yield. The yield goes down because there's more buyers. Well, when there's less buyers, the yield goes up because the price is lower to buy that bond. When we saw the big sell-off in the stock market, and and we heard about how the stock market dropped significantly, and they're still significantly off the highs. Well, when that money comes off the table in the equities market, the stock market, historically, the money then goes into safe haven assets, which are bonds. It was very interesting that did not happen most recently. What that means is that people who were investing in the stock market cashed out and sold as it was going down. Then they kept the money on the sideline. They didn't put the money in bonds. So it kind of gives you an indication of the psychology of the investors. And that maybe they're putting the cash on the sidelines to just keep catching these little dips that happen. And sure enough, there was a lot of money that was made then when things rebounded a little bit. And the rebound really happened after President Trump made the announcement that they were putting a 90-day pause on these tariffs being enacted so that they could negotiate. And honestly, putting that 90-day pause helps companies to manage what they're going to do about their supply chain. So that is our update for today. Stay tuned later on next week for the next couple episodes of the podcast. I hope you found this information helpful and useful as you're heading into the weekend and doing your shopping. Feel free to reach out. My email address is peter.d'angelo@rate.com. Also, follow me on socials. If you have any questions, would love to hear your feedback. Be sure to like and subscribe, and I look forward to giving you your updates later on this week with some information about New Jersey housing as well as exploring FHA loans. Have a great weekend and take good care.